introduction, let me just mention some important concepts. Every time you're computing the net present value of an investment, every time you're computing the NPV, there are three types of cash flows that are always affected. So, in computing the NPV, there are three types of cash flows that are affected. The first type of cash flow is the initial cost. And the second type of cash flow is the terminal. The terminal cash flow. And we have the annual net cash flow. There are some instances these cash flows may be given. So this is the initial cost. The initial cost, the terminal cash flow, and the annual net cash flow. So this is what we've been talking about in our financial management class, both in FM and advanced FM. But inside Excel, you may still be required to compute these NPVs, and some instances you may not be given the cash flow. So you have to know that if you're not given the initial cost, then how do you get the initial cost? What are the components of the initial cost? So the initial cost is made up of, let's say, the cost of the asset or project. Then you add an incidental cost which is associated with the asset or the project. So when you add incidental cost is any cost which is directly tied to a particular asset or project. So that if it is an asset, we can have things like transportation, we can have things like import duty, we can have things like overall. Overall is the same as saying just some form of modification. etc. So there are very many incidental costs that we can consider. And because incidental cost is directly embedded on a particular asset, you cannot separate the cost of the asset from its incidental cost. So that when charging depreciation, the qualifying cost must also include the incidental cost of the asset. And the next component is the investment in working capital. Acquiring the asset, there are some working capital items that may be required for you to start using the asset or for you to start generating income from the asset. So we need to add the investment in working capital so that this will give us the total initial cost. But please remember that when charging depreciation, the depreciation is only on the cost of the asset plus the incidental cost. So this is the qualifying cost for purpose of depreciation, which means that the investment in working capital is not included when you're going to charge, when you're assigning the depreciation cost of the asset. So these are the components of the initial cost in a scenario where you are not given. The reason why this is important is because sometimes the question may want you to carry out sensitivity or scenario analysis on specific variables, so that you have to know what forms that component of cost. And definitely we know that the initial cost is a cash outflow. And this is very important. If you know that the initial cost is a cash outflow, in the worst case scenario, you expect cash flow items to increase. And in the best case scenario, you expect the cash flow items to decrease. That is the initial cost. Then the second type of cash flow we have is the terminal cash flow. The terminal cash flow is the cash flow at the end of the asset's useful life. So that if an asset has a life of 5 years, then my terminal cash flow will be at the end of year 5. If my asset has a life of 6 years, then my terminal cash flow will be at the end of year 6. So if you're not given the terminal cash flow, then you can compute the terminal cash flow by having the salvage value plus the working capital recovered. Plus the working capital recovered. So if I take the salvage value plus the working capital recovered, that will give me the terminal cash flow. So the working capital to be recovered is this exact working capital that was invested. So this investment is what is always being recovered. So that if there was no investment in working capital made, then there'll be no working capital to be recovered. That is how you get the terminal cash flow. Another thing is that sometimes you may be given this salvage value, but it may have different names. If we don't call it salvage value, we can call it residual value or nominal value or scrap value or resale value. It still means the same thing. And let's note that this is the value at the end. Another thing is that this terminal value is actually a cash inflow. So that when you're talking about scenario analysis, in the best case scenario, we expect positive cash flows to increase. And in the worst case scenario, we expect positive cash flows to decrease. That is how we get a terminal cash flow. Then we have our third type of cash flow, which is the net cash flow. If you're not given this net cash flow, then it will be given by the earnings before depreciation and tax, 1 minus tax, plus depreciation tax shield benefit. The earnings before depreciation and tax, 1 minus tax plus the depreciation tax shield. So this depreciation tax shield is actually a form of capital allowance. The depreciation tax shield is actually a form of capital allowance. And this net cash flow is per annum. And there are some instances where the question may not give you the earnings before depreciation and tax. So in such a case, if you are not given the earnings before depreciation and tax, then we can take the revenue, which is the sales revenue. Sales revenue is the same as saying the turnover. We less the variable cost. When you less the variable cost, you get the contribution. When you get the contribution, we less the fixed cost. And this will give us the earnings before depreciation and tax. This is also very important so that if you're not given these, you know what forms the earnings before depreciation and tax so that you can be able to compute the based on the individual components. Just like anything that we've said about scenario analysis is that revenue items in the best case scenario we expect it to increase, and in the worst case scenario we expect it to reduce. Cost items like variable cost and fixed costs, in the worst case scenario, we expect all the cost items to increase. And in the best case scenario, we expect the cost items to reduce. So this is how we get the earnings before depreciation and tax. In some instances, you may be given the earnings, but they will be presented in form of cost savings. So every time you're having savings on cost, then it's the same as you having earnings. So earnings are equivalent to cost savings. Then T is corporation tax rate. T is corporation tax rate. T is corporation tax. And DTS we've said is the depreciation tax shield. This is earnings before depreciation and tax. And DTS is the capital allowance, which we are saying is the depreciation tax shield benefit. So if this is the depreciation tax shield benefit, if you want to get the DTS per annum, the DTS per annum is given by the depreciation per annum. We multiply by the tax rate. The depreciation per annum times the tax rate gives us the DTS per annum. So if you are not given the depreciation per annum, then it will depend with the method of charging depreciation. Depreciation can either be on straight line or it can be on reducing balance. It can either be on straight line or reducing balance. We are using straight line method of charging depreciation. Then, in such a case, we'll take the cost, but this cost must only include incidental cost. If it is there, you should not take the total cost. It is only cost plus the cost of the asset plus the incidental cost, minus the salvage value, not the terminal cash flow, but the salvage value. We divide by the life of the asset. This will give you the depreciation per annum using straight line method. And because we are using straight line method, we expect depreciation per annum in every year to be the same, and at the same time the capital allowance in every year to be the same. If we are using reducing balance, then we must have a rate to charge using reducing balance. And reducing balance means that we'll be charging depreciation on the written down value of the previous year. And because it is reducing balance, definitely the capital allowance every year will be varied. It will not be the same, because the depreciation for every year will be different. That is how we use reducing balance. After getting the DTS, now we can be able to get our net cash flow. After getting the three types of cash flows, which is the initial cost, the terminal cash flow, and the net cash flow, we can now try to get our NPV, but we need the period N and the discounting rate R. The period N under sensitivity analysis or scenario analysis, because the period N represents the life of the asset. In the worst case scenario, we expect an asset to have a shorter lifespan. And in the best case scenario, we expect it to have a longer lifespan. So that when carrying out sensitivity analysis or scenario analysis and the life of the asset is affected, then you have to recognize that in the best case, the life of the asset should be longer, and in the worst case, the life of the asset should be shorter. So we know that R represents the discounting rate. This discounting rate is the minimum rate of return. And this minimum rate of return is also known as the cost of capital. It is also known as the cost of capital. Sometimes the discounting rate can be presented as the weighted average cost of capital. Weighted average cost of capital. So after getting all these items, now you can be able to get the NPV under different scenarios or under different change in variables. And when going to get the NPV, because already we are experienced in Excel, we'll now use the NPV function to get our NPV. But another important thing which I have to say before we do a question is that if you're told to get the best case NPV, the best case NPV is the most likely NPV. This is the NPV that we get assuming there is no change in variables. Assuming no change in variables. This is the NPV that we get assuming no change in variables. This is the best case NPV. So the NPV that we compute for the first time without making any adjustment, that is what we consider as the best case NPV. So with this background, I want us to look at a question, and let's go to our Excel so that we try out this question. These are sample question on scenario analysis, and we are told that Riziki Limited is considering a project with the following details. The initial capital cost is 40 million. The residual value is 2.5 million. The selling price per unit is 1100 and the variable cost per unit is 500. The fixed cost per year is 5 million. The annual number of units sold are 30,000. The project has a useful life of 5 years. The company uses the weighted average cost of capital. So the question wants us to compute the base net present value. And then at the same time, the question wants us to carry out sensitivity analysis of the NPV, assuming an adverse variance of 5% for all, assuming an adverse variance of 5% for all the input except the project life and the weighted average cost. So that is sensitivity analysis on all the variables. So the question is telling us that all the variables are expected to change adversely by 5% other than the life of the project and the weighted average cost. Prepare an appropriate chart to indicate the different NPVs for each scenarios in B above. And note that adverse variance is a case, in this case, means a decrease in cash inflow and an increase in cash outflow. So let's start by getting the best case, the best net present value. So for us to get the best net present value, first of all, we have to consolidate our item. So let's start with let's have our solution here. And the first item is the initial cost. And we know the initial capital is 40 million. So we can have that initial capital, we can just copy it, there is no problem. Because we are certain that these are text and numeric values. That is our initial capital. And there is no other additional cost which is related to that capital. So we have to look and confirm that there is no other component of the initial cost. Remember, we are talking about the initial cost is cost at year 0. There may be other components of cost, but those components of cost may be affecting the net cash flow. Then the next item we have is the residual value. which in this case, this residual value is equivalent to our terminal cash flow. So this residual value is actually our terminal cash flow, and it is the value because this project has a life of 5 years. This residual value is the value at the end of year 5. At the end of year 5. This residual value is the residual value at the end of year 5. Then the next item that we need is our net cash flow. And if you look at our computation from our whiteboard, we say that the net cash flow is given by the earnings before depreciation and tax, 1 minus tax, plus the depreciation tax shield. So the question is not talking about taxation, neither is it talking about the DTS, which in this case is the capital allowance. But we can get the earnings before depreciation and tax, which is given by the revenue, the variable cost, and less the fixed cost. So because the question is silent on tax and DTS, I know of some students who always decide to assume that because the question has not provided for tax and DTS, then it assumes that this NPV was being computed without in considering the impact of taxes and capital allowance. There are students who choose to ignore that aspect and assume it does not exist, and there are students who still choose to incorporate that. So depending with what you do, what is important is you have to be very sure about what you are doing, because the whole idea is to test on knowledge of the concept. If you decide to introduce tax in the question, then it means that you have to bring that assumption. But before we introduce the taxes, we need the earnings before depreciation and tax, and the earnings is given by the earnings before depreciation and tax is given by the revenue with less variable cost and with less fixed cost. But the question has not given us revenue, but we can actually compute the revenue because the revenue is given by the unit selling price, which we are given. We multiply by the units. And if you want to get the variable cost, we'll take the unit variable cost. We multiply by the units. So for us to be able to get the earnings before depreciation and tax, we have to take the unit selling price, the unit variable cost, so that we're able to multiply it with the actual production. And we are given in our question the unit selling price, the unit variable cost. So let me have these. We have the unit selling price and the unit variable cost and the total fixed cost. And the question has also told us the annual number of units sold is 30,000 units. So remember what we said from day one, you have to separate text values from numeric values. So let me type this as annual number of units. You should not mix text and numbers within the same cell, not unless you're writing a normal text. But if you have to distinguish a number from a text, then the annual number of units should be the text value, and the actual unit, which is 30,000, is the numeric value, and that should be presented separately. That is the annual number of units. So now that we have that, we can be able to get our earnings before depreciation and tax. Earnings before, you can just put the initials because we are experienced students. You should not assume that the examiner will not understand. From where we are up to the business data analytics class, every time we write EBDT, any student should be able to know that this is the earnings before depreciation and tax. So now that we want to compute the earnings before depreciation and tax, and you realize that there's something I'm doing deliberately. I'm ensuring that every variable is on its own separate cell, so that when I'll be carrying out sensitivity or scenario analysis, I can reference that particular cell, and that is very, very important. We said it from the beginning, and I'll still repeat that you must always reference a cell in your computation inside Excel, not unless you'll not need that the content of the cell to change. Then in such a case, you may be allowed to reference the value, but always make it a habit of referencing a cell so that you are able to adjust the content of the cell, or you're able to make your data set to be very dynamic. So as a matter of caution, it is not wrong for you to present all variables or all items in the individual cell so that it makes it very easy for us to do our workings, especially when talking about sensitivity analysis, scenario analysis. Now, in such a case, it is almost crucial that you have every item in their separate cells. And as we finish this question, I'll tell you why, because we have to go and use the scenario manager where you can be able to now reference the cells and do the computation under different scenarios. But for someone who did not reference the cells correctly, it will become very difficult to do that. So now that we have that, we can be able to get our earnings, because we know that if I take the selling price minus the variable cost, I can be able to get. So let me just say open bracket. I take the unit selling price. Okay, let me use bracket so that it becomes easy for us to work. So I'll start with the equal sign. Every time you compute a function, you start with the equal sign. I'll reference the selling price minus the variable cost. Then I close the bracket. That gives me the unit contribution. Then I multiply by the units, which is 30,000. So when I take the selling price minus the variable cost, I multiply by the units, I now get the total contribution. But I need to minus the fixed cost. And because of our understanding of BODMAS, if I want to subtract the fixed cost, let me introduce another bracket so that it becomes very easy. I always prefer using brackets just in case there are some values that I want to introduce an opening bracket so that I close everything in one bracket as the total contribution before I minus the fixed cost of 5 million. So you can see that the contribution, I have now the total contribution in one bracket, in one whole bracket, minus the fixed cost. In case using brackets, it's a challenge for you. You can decide to have the total contribution separately. Fixed costs, you can decide to do your working separately and add them up. At this point, if you are very experienced in Excel, you'll choose what works for you. Because some people may have difficulties using brackets. Sometimes without brackets it does not work. Sometimes with bracket it works. But as a matter of caution, personally, I prefer using that because when you use when you apply addition, subtraction, multiplication, it becomes a bit chaotic. So to guarantee that BODMAS works, you can always just use brackets as a matter of safety, but you are free to choose the option that works for you. So once we've had that, then we just say enter. So that this is 13 million. So 13 million is our This is the earnings before depreciation and tax. And these earnings before depreciation and tax is annual. I think I have to emphasize that this is annual. This is annual or this is per annum. Annual. So this is the annual earnings before depreciation and tax. So now that I have the earnings before depreciation and tax, remember this question was silent on taxes and it was also silent on the capital allowance. You can decide to ignore that part or you can decide to introduce it. Sometimes also the question makes it very easy and just says that you ignore taxes. So definitely if the question says ignore taxes, then now it has killed that debate and you are very sure that you have to compute the NPV without considering the aspect of taxes. But if you choose to introduce taxes and DTS, so let me just introduce the taxes and DTS for the sake of understanding, because if I chose to ignore taxes, then it will mean that these earnings before depreciation and tax will be equivalent to the net cash flow. Let me just go back to our whiteboard and make that clear that if I chose to assume that there are no taxes and there are no DTS, then this will imply that the net cash flow will be equal to the earnings before depreciation and tax. That is, if we say that there are no taxes, and if there are no taxes, then we don't expect to have DTS. And that is why we are saying this will be the final position. So if that was the case, then automatically it will mean that our 13 million will be the net cash flow. But for the sake of understanding, I want us to try and introduce taxes and DTS. Let's assume, then definitely you have to, it is always proper that you state that assumption. It is always proper that you state that assumption so that you lock the examiner to your line of thought just in case let me maintain this font size of times New Roman, of which size that is size 20. Let me maintain size 20 times New Roman. So I'll just highlight that, Control Shift down. Then I say times New Roman, and I want it to be 20 so that I have consistency. Okay, it's okay now. So it is, as a matter of caution, it is just good to state that you've made this assumption so that, especially because this is an exam and you are not sure how that marking scheme was presented. And so we can just say that assuming corporation tax rate is 30% and the company charges depreciation. And the company charges depreciation using straight line method. So this is just a way of locking the examiner to your line of thought. And another thing also, the reason why I'm doing this is because you can now have an actual example where the question is very clear, there's tax, and also the method of charging depreciation is very clear, whether it is straight line or reducing balance. So in our case, what is important is your knowledge of the concept, not really the question, so that in a scenario where you are in the exam, now you choose how you want to go about it. In any case, ignoring taxes and DTS is the easy part. So let's just try to make this question a bit complex for the sake of understanding. So now that we've made this assumption, we'll say that our taxes, we'll say that the corporation tax, the tax rate is 30%, and you can see that I'm presenting the tax rate as a text and the 30% as a numeric value. That is very important. So now I need to introduce now the capital allowance. And this capital allowance is what I'm calling the DTS. This capital allowance is what I'm calling the DTS. And already we've said that DTS is given by the depreciation per annum times the tax rate, because I've assumed straight line. If you go back to our whiteboard, we said that if you assume straight line, then we'll take the cost minus the salvage value, we divide by life. Then you multiply by the tax rate to get the DTS. And that is exactly what I want to do. So for us to do that, let's first of all get the depreciation per annum and reference where we have the cost. We minus the residual value, and because I want to divide by the life of 5 years, let me do this because I don't want to. Okay, there's no problem. I can decide to remember what I said. You can reference a value if you don't expect it to change. But as a matter of safety, I can just write here, can just put it here, life in years. But even if I was to include it there manually, there could be no problem, life in years. So if I have the life in years, let me just say 5. So that now I can get my DTS and say that equals to the cost minus the salvage value. But because I want to divide it by 5 years, so this is what I'll do. I'll take the cost minus the salvage value. I put everything in bracket because it is this difference is what I'm dividing by 5 years. So I'll say open bracket and close the bracket. Then I divide by 5. So it is whatever is in the bracket, I divide that by 5. That will give me the depreciation per annum. But if I want to multiply by the tax rate, I want now everything in this bracket. So I can introduce another bracket and say open bracket and close the bracket. So you can see that my 2 main brackets is for getting the depreciation per annum, but now the final bracket, I want to take this depreciation per annum, I multiply by the tax rate of 30%. In case you don't want to use these many brackets, I've already mentioned that you are free to, you can compute the depreciation per annum in a separate cell. Then now is when you proceed and get the DTS. There's no problem. You don't have to strain with all these many brackets. But if you understand how to use brackets, there's no problem. In case if you're finding it too messy, just compute the depreciation per annum in a separate cell, and which is a very safe method I'll recommend, especially if you are not sure how the result will be. So I'll recommend that you can still get the depreciation per annum separately. Then you multiply by the tax rate. There is no problem still. So now that I've gotten that, then I just say enter. So in this case, now this is our DTS. So this is my DTS. So the DTS is 2.2. And you can always cross-check just to be sure that you've referenced the right values. And that one is okay. So after getting the DTS, now we can be able to get our annual net cash flow. We can be able to get the annual net cash flow. And that is what we needed. So the annual net cash flow now will be given by our earnings before depreciation and tax. Let me go back to our formula so that I show you what I'm trying to do. We said that the annual net cash flow is given by the earnings before depreciation and tax, 1 minus corporation tax, which I've assumed is 30, plus the capital allowance that I've computed. So I can be able to get the net cash flow. So the annual net cash flow, I'll say, equals to the earnings before depreciation and tax. I know corporation tax rate is 30%. So I'll take that earnings, I multiply by open bracket. You must always use the multiplication sign, 1 minus the tax rate, which is 30%. Then you close the bracket. So when I take the earnings before depreciation and tax, I multiply by 1 minus that, then I add depreciation tax shield benefit. And this depreciation tax shield benefit is our capital allowance, which is 2.2. And that is how we go about it. We take the earnings before remember, Excel, you have to include the multiplication sign. We've always said that it doesn't read the normal bracket. Just because I've said here, open bracket, inside Excel, you have to still include this multiplication sign, because I've always seen students having that problem. You have to multiply, because Excel does not treat this bracket as multiplication. That is why I've still proceeded and introduced this multiplication sign here. So now that we have that, we can have our annual net cash flow. So that the annual net cash flow is 11,350,000. And you can always cross-check just to be sure that you've referenced the right cells, because I've taken the earnings. That earnings you multiply by 1 minus 30%, which is 0.7 times the earnings. Then you add the net cash flow. So that one is okay. After getting that, now I have my 3 cash flows. I have the initial cost. I have the terminal cash flow, which is the residual value, and I have the annual net cash flow. And this annual net cash flow is generated every year for 5 years. And you can see that I've separated the text and the numeric values. And this is very deliberate, so that when I'm going to now do my sensitivity analysis, it becomes very easy to reference cells. And I've always encouraged my students to make sure that you reference cells where the text values are separated from the numeric values, because it makes sensitivity analysis and scenario analysis to be very, very easy, so that you only need to do the computation once, and in the subsequent events, now you just need to reference the cells that has the values that you want. So let's get now our net present value. Before we get the net present value, we have one last thing that we need to introduce, and that is the discounting rate. And the question told us that we use the weighted average cost of capital as our rate, and the weighted average cost of capital is 12%. So let me have these as weighted average cost of capital. So the weighted average cost of capital, I'll introduce the text value of work. Don't say weighted average cost of capital 12%. Now all these are text values. Don't say this. You have to input the text value of weighted average cost of capital. Then the numeric value of 12%, you have it separately. So from there now I can be able to get the NPV, and because we've talked about the NPV before, we'll use our net present value function and just say equals to NPV. Then you activate the function argument, and I always prefer using the window. The rate you just reference where we have 12%, and the value, let me see. Okay, let me just cancel this. There's something that I want to do which is very important. So you'll realize that the 11,350,000 is a single value, but it is a value which we are generating every year for 5 years. So to make it easy for us to get this NPV using the values, I cannot reference this single value once. So what I can do, this is what I'll do. But there is the option of using the annuity table, but not the annuity table, but the present value function. We can still use the present value function, but I think for the sake of flow and for the sake of clarity, let's do this. This 11,350 is every year for how many years? Every year for 5 years. So what we can do, we'll have the period, then we'll have the cash flow, so that we're able to reference the entire. So we'll have period. This is much better, and cash flow. So I have period 1 up to 5. Period 1 up to 5. And each of these periods, we are getting a cash flow of, and you can see that I'm not typing this value manually. I'm actually referencing this cash flow. The reason why I'm referencing this cash flow is this is very, very important, so that when I carry out sensitivity analysis on this variable, it is also linked to this entire computation. Otherwise, if you don't do that, then your data will not be dynamic. So please note that I've actually referenced this cash flow, and the cash flow that I've referenced is also referenced on the previous cash flows. And the previous cash flows that I've referenced are referenced on other previous cash flows. So you see how the data is linked from one step to the other up to the time you're getting the NPV. Because if your data set is not linked, then it will be very, very difficult to get what we want. But this cash flow is constant all the way through. So what I can do to guarantee this cash flow being constant, I can make this an absolute reference. I can reference the range of B358 and just click the $sign F4 once. So that now I've made this to be an absolute reference. The reason for making this an absolute reference is because I'm trying to avoid a problem here. This is the problem I'm trying to avoid. Let me just emphasize why making this an absolute reference is very important. You can see that I've taken the same value, I've locked it to the value above, I've made this an absolute reference. If I didn't make this an absolute reference, this is what will happen. I didn't make this an absolute reference. You can see that now we have a problem because it is always referencing one cell downwards, one cell downwards. So to avoid that, I just make absolute reference and click F4 once. Though I've had instances where there are some students when they press F4, depending with the type of computer that they are using, the F4 does not always lock it an absolute reference. So they always have that challenge. The other option, you can still insert the $sign manually. The idea is to lock column B and row 38. So in case your computer has challenges doing that, then you can just go just before B. You can just look for the $sign and press the shift of, you look for your $sign and you just press the shift of 4 just before B. If I insert the $sign before B, it means I've locked column B. But I also want to lock row 38. So I move to the next cell and I insert the $sign just before 38. So in that case, it means I've locked B and I've locked column B and row 38, and that is still okay. You don't want to do that manually, you just highlight the range, just like I've said before. Then you press F4 once. If you press it more than once, it will always move the reference that you want to make absolute, either in the column or the row. So just press it once to lock both the row and the column. If you press it the second time, it will either lock the column only. The third time, probably the row only, something like that. So just press it once until you are sure that the $sign locks both the column and the row. Then you just say OK. Then now you drag across. So you ensure that this is an absolute reference. So now that we have that absolute reference, we can proceed and get the NPV. But there's one important step that we should not forget. And this crucial step is that when computing the NPV, you must include all the cash flows. Most people, they always forget the cash flow at the end of year 5. Remember, we have a terminal cash flow. We have a terminal cash flow of the residual value is 2.5 million. So we have to include this residual value in our terminal cash flow or in the cash flow at the end of period 5. Most students, they always forget to include that residual value when computing the NPV. So at the end of the last period's cash flow, we can actually add that residual value. So that if I want to add this residual value, then I'll just go to my computation and say plus. Go to my computation and say plus the residual value, which is a reference where we have 2.5. So that now it will be 11,350 plus 2.5 million. And you can see I've referenced the cell that has 2.5. So that now the cash flow at the end of year 5 now has the cash flow that was generated plus, let me just confirm if I've referenced the right cash flow, 2.5, that one is okay. While I was calculating DTS, let me just cross check whether I referenced that 2.5 as my salvage value when computing DTS. So that was the cost. So that's okay. Everything is okay. So now that I have the total initial cost, the annual net cash flow, and the terminal cash flow, I can now get my NPV using the function and say equals NPV. And I can open the function argument. I reference the rate of 12%. Then I highlight my values. In this case, I'll take the range of values from 1 to 5. Remember, the net present value function only takes cash flows from period 1. After taking that, we can proceed and minus the initial cost. So there are two ways you can do that. The first possible way is that after referencing the range of values, I can go to my formula where we have just above at the formula bar. I can go to the formula bar. Let me just show that. I can go to the formula bar. This is our formula bar. This part, I can still do my computation here because I already have the present value of cash inflow. Can as well just go direct and minus the initial cost from there. That is one way. The other option, I can just work it out inside the cell. So in this case, I can go to the formula bar and say minus, because I've presented the initial cost as, I've not presented it as a negative, I can just say minus that. And if I say minus that, you can already see that the formula has given me the result of my NPV. Then I just say, okay, and this is our NPV. That is one way. If you're not comfortable going that route, this is the other option. Let me delete that and say equals NPV. I activate the function argument. Then I go to the rate, 12%. Then I highlight the range of values. But this time round, I just say okay. Then later on, I'll click on this formula and come back and I say minus the initial cost of 40 million. That is still okay. So it has very many decimal places. So I can decrease the decimal places. Maybe I can have it to that. So this is how we get our NPV. And the beauty of all this process is that I've referenced my data so that anything that I'll be doing subsequently, I've already referenced my cells correctly. So it will be very easy going forward. So that is how we compute the best case NPV. That is the NPV without changing any variables. So the next part, we are told to carry out sensitivity analysis of NPV, assuming an adverse variance of 5% for all inputs except the project lives and weighted average cost. So the question is telling us that all the variables affecting NPV are expected to change adversely by 5%. So adverse by 5% will mean that it is not a positive change. It is not a good change. So if the change is adverse, you have to ask yourself whether it's an inflow or an outflow, because an adverse change in an inflow is expected to decrease, and an adverse change in an outflow is expected to increase. So if that is the case, then we have to change all those variables adversely by 5%. But the only thing that will not change is the life, which will remain to be 5 years, and the weighted average cost, which will remain to be 12%. So let's talk about the adverse change in variables. Let me introduce a column here for 5% adverse change. 5% adverse change means what? For the first item, which is 5% adverse change, we have the initial cost. So if there's a 5% adverse change in the initial cost, we expect the initial cost to increase by 5%. If it increases by 5%, it will be 105% because that is cost. If you look at the residual value, remember, is the same as saying the salvage value. If the residual value is adverse by 5%, then we expect it to decrease because it will reduce our earnings or it will reduce the net cash flow. So we expect it to decrease. We expect it to decrease by 5%. And if it decreases by 5%, then this means that it will have a net of 95%. Then when you talk about the selling price, if there's an adverse change in selling price, remember selling price increases our inflow. So if the change is adverse, we also expect the selling price to decrease by 5%. The variable cost, because that is a cost item, if it is adverse, we expect all the cost items to increase. We expect all the cost items to increase. To increase by 5%. Same case applies with fixed costs. We expect it to increase by 5%. Annual number of units, the units sold increases our earnings. So if it is adverse, we expect it to decrease by 5%. And because this is not the variable, so this one is a product of our calculation. So the other variable, so we are told that the life will remain constant. So this one will not change. So we will not make any adjustment. And also the weighted average cost of capital, which is 12%, will also remain constant. And that is what the question says, that all these variables will change adversely by 5%. So we carry out sensitivity analysis of NPV, assuming adverse change for all the inputs except the project life and the weighted average cost. And you can see that we've shown how all these inputs will change adversely. So for me to do this, because I've already referenced my cells correctly, I'll have to use the scenario manager. But before I use the scenario manager, let me first of all highlight or select the cells that has the variables that I want to change, so that all these variables are changing up to there, and there's no other variable. This is constant and the other one is constant. So once I've selected the variables that are changing, then now I'll go to, and remember I've already referenced this cell. So I'll go to data. Under that, I'll go to what if analysis scenario manager. Maybe let me delete these scenarios because they may be part of some other workings I was doing, so that we start afresh. So when you go to data, in case there is no existing scenario that you've done, let me just go back and say, what if analysis scenario manager. It gives me the option to add a scenario. So before you make any changes, first of all, let's add the existing scenario, the one that we computed. You must always save the current scenario so that you don't lose anything. Let me call it the best case scenario. The best case scenario. Let me call this the best case scenario. And I've already highlighted the range of cells that I want to change from B27 to B32. So now that I've called this the best case scenario, I'll say okay. And these are the values in all those scenarios, the 40 million, the likes. So once I've done that, I'll just say okay. So now that I've saved the best case scenario, even if I close this window, it will always be automatically saved. So there is no problem. So that even if I go back to my data scenario manager, the best case scenario is already there. So I want to add another scenario by now changing these variables. So I'll say add another scenario. And because there's a 5% adverse change, it's not a positive change. So let me call this the worst case scenario. Let me call this the worst case. Worst case to mean because adverse is not a positive change. So let me just say it's worst case. So if I call this worst case scenario, now I want to adjust these variables. The first one was the initial capital, which was 40 million, and we said it increases by 5%. So instead of doing that working somewhere else, I can just go to where my first variable is inside this computation. I introduce an equal sign, then I multiply this scenario by 1.05. The reason I multiply by 1.05 is because if it increases by 5%, it is 105%. Then I'll go to the next variable, which is residual value, just where the 2.4 begins. I introduce an equal sign. Then I multiply by, because it decreases by 5%, I multiply that value by 0.95. If it decreases by 5%, it will be 95%. That is why I'm saying 0.95. Then the next one is the selling price. Again, I multiply by times 0.95 times 0.95 because we are saying that it decreases by 5%. Variable cost increases by 5%. You must introduce that equal sign because now I'm treating it as a formula or as a function so that it becomes very easy to do the Excel will do the computation for us later on, so that we just set it up nicely. If it increases by 5%, that is times 1.05. Then the next one we have is the fixed cost. That one also, because it's a cost item. In the worst case scenario, you expect cost to increase. So I'll say times 1.05. And then the last one is the annual units, that is production. In the worst case scenario, which is adversely by 5, we expect it to reduce. So I'll say times 0.95. So once I've set up things nicely, you have to drag up to downward so that you ascertain that you've included everything. Then once you've done that, you just say okay. So when you say okay, there's a warning that will appear in Excel and it will tell you that the names and results of formulas were converted into values. So Excel has realized that I'm trying to multiply these values and it's ready to convert and do for me the computation and give me the exact value, so that if I say okay, when I go back to those specific cells, I'll now get the actual computation. So every time you get this warning that appears, just say okay, because Excel will do for us that computation. It will convert those formulas into values, and that is exactly what we want it to do. So you just say okay. So if we go back to our worst case scenario and we try to edit it, and I say okay. If I try to edit the worst case scenario, you can see that now the story has changed. Initially we had 4 million, 40 million, now we have 42. It has increased by 5%. For the residual value, we add 2.5, now it is 2.375, it has decreased. The selling price was 1100, now we have 1045. It has also decreased. So you can see that Excel has already adjusted It has already adjusted those values for us. And that is what we were saying. So now that we have our scenario, even if I close this window, because I reference all these variables, I already referenced it up to my NPV. I don't need to do the computation again. I'll just go to my data and the what if analysis scenario manager. Then I'll say show scenario. If I say showcase scenario, you can see that my NPV has changed. And in the worst case scenario, it has already done the adjustment for us. And you can even see the way we reference the cells, it's very consistent. The initial cost is 42. The residual value, the selling price has changed. The fixed cost has changed. The earnings has also changed, referencing the same values. The life is still 5 years. Capital allowance has referenced the cells that has the changes. And you can also see that because I referenced these cells correctly, this is very important. Remember where I made an absolute reference. The 90, 76, 500 is what has been captured all the way through. And it has also considered the terminal value at B28, and this time round it is 2375. Just have the click of a button, and because we reference our cells correctly, when 5% adverse change in variables, we've been able to compute that NPV automatically without having to do any serious changes. And that is what happens. And because I saved the original scenario, there is no problem. I can still go back to what if analysis scenario manager and go back to the best case scenario. And I say show the scenario. And all the scenarios are still available. Very easy once you know how to reference cells and how to use scenario manager. But for someone who did not reference the cells correctly, trust me, it will not be possible to get that value. And that is why in the first lesson, I've always insisted on knowing how to use relative and absolute referencing, because once you know how to do that, it becomes very easy for you to master how to work inside Excel, because 80% of what we are doing in this class, we already did in our normal class over the course. So what is now being tested is, can you be able to work inside Excel and still do the same thing? And that is why I've always insisted on mastering Excel skills, because whatever we are doing is just a recap of what we already did in class. So you need both the knowledge in class and the knowledge of Excel for you to be able to also finish this on time, because you can see I've done that with less than under a minute. I've been able to do all those scenarios just because I was able to reference the cells correctly from the word go. But at the end of the day, we have to answer the question. So remember, the question was to carry out sensitivity analysis of the NPV assuming adverse change in variables. So whatever we've done, we've not carried out sensitivity analysis. We must be able to answer the question. So for us to be able to carry out sensitivity analysis, so this is what we can do. Remember, my formula or my result is hidden inside the scenario manager. And sometimes you don't expect this examiner to go to your scenario manager. So to make it easy for you to showcase your answer, this is what you can do. Because at the end of the day, we are focusing on the NPV under different scenarios. So what I can do to make it easier to showcase my answer, I can call this the best case scenario. And call this the best case scenario. The best case scenario. And I can call this maybe the worst case scenario. Just now, for the sake of presenting the answer clearly, as much as we've gotten the answer, we also have to be able to make it easier for the person looking at our work to also get a picture of what is happening. So we can have also the cash flows, and I want to go back to what if under scenario manager and now switch to and showcase the worst case. So under this worst case, what I'm interested in these values under the worst case scenario, but I want them as, I'll copy, but when I go to paste, there are two types of paste option. I don't want to paste. If I use the other paste, when you click paste, if I use the normal paste, you can see that it is giving me an error. So I want to paste the value so that I get rid of the formulas and any referencing that I did, because that is what I'm interested in. So I'll proceed and paste the value, so that now when I paste the value, when I go back to my scenario, you must paste the value, and this value now is not linked to the formula, so that now even if I go back to my scenario manager and go back to the best case scenario, the values are still there. So this time round, because I've pasted the values, I can now showcase that this is the NPV, and probably I can make this red the way it was. So this is now the NPV in the worst case scenario and the NPV in the best case, which is the normal scenario. So we can decide to show the change in NPV and saying that the change in NPV will be given by the new NPV in the worst case scenario minus the best case NPV. I can also divide by the original NPV. So let me use bracket and say open bracket. And then we close the bracket. You divide everything by the base. So the whole idea, I want to try and present the change as a percentage, to mean that the new NPV minus the old NPV divide by the old NPV, then I can even convert it as a percentage, and that is what I'm trying to do. So it is minus 79 minus the original NPV divided by the original NPV. This is 4.4. If we have 4.4, let me see as a percentage. As a percentage, it's negative 440%. So negative 440% means what in relation to the change? Remember, we had a 5% adverse change. So this means that a 5% adverse change in all the variables other than the life of the asset, which is constant, and the weighted average cost causes a 440% decrease in NPV. That is what it means. That is, now we have been able to carry out sensitivity analysis and made sense of this. This implies that a 5% adverse change a 5% adverse change in all the variables other than the life and the cost of capital causes a 440% decrease in the net present value of the project. This is what it means. So now we are able to communicate and also answer the question. Then the other part we are told is to prepare an appropriate chart to indicate the difference in the NPVs. So for us to prepare an appropriate chart, this is what we can do. For us to prepare a chart, maybe just as a, let me just say something which is important. We can always develop a summary. If you go to our data set, what if analysis, so that we're able to communicate fully under scenario manager. You can be able to go to summary so that we show the summary. And in this case, the result is where we have our NPV. So the result cell is the cell where we computed our NPV. So we want the summary of the scenarios, but we want the result cell to be the NPV that we computed. So that once I've said the summary, then I'll just develop the summary report and say, okay. So in most cases, the summary will appear in a new Excel worksheet. And you don't need to worry about that. In case the summary appears in a different worksheet, what you can do, we can just copy this, because this is what we want. Then we can take it to our we can bring it to our normal working area. Let me just change that. We want the formatting option, which is, let me see. Let me try to unmerge that. Let me resize this to something reasonable. So I think it looks okay. Let me just see what we can get rid of. There's some things we don't need, so we can delete that. We can also, let me see what can be moved. Okay, we can just increase the size of this so that this is, let's make it Times New Roman. And also we have the same size so that, exactly, so you can have it at 20. Then another adjustment we can make, the result is these are NPVs. So this is what we can do. It has reference B27 all the way up to B32, and you can see that this is the variables. It has referenced the variable that we are changing, the B27 and B32. So what we can do, we can just delete, because these are the variables that we're changing, B27 to B32. This is my B27 to B32. So I can just copy this and I can proceed and paste these here, B27 and B32. And because we don't need this space, let me just utilize this space. These are the changing. Instead of changing cells, I can call these changing variables. And call these changing variables. Then I can also move these. And B47 is actually the NPV. If you look at cell B47, if you go to B47, that is our NPV. So instead of saying changing cell, I can just delete this and say net present value, or I can just say NPV. Then I can move these two, can move the 3 up, so that I get rid of this because we don't need it. And then what else can we move? Let's see whether we can move. Okay, let's have, instead of saying results, let's move this NPV here. Yes, so we want to replace that so that we move all of these. So that we move all of these. Then we can now get rid of this. Let me see if there is anything. Okay, there is something in this column. So what we can do, and just clear the formatting, clear all. So this is now our, can make background, can make this white, and we can make our text black. These are the current values and the best case. So these are our variables that we're changing, and this is our NPV. And this is just a summary of our, so we can move this up. We can also get rid of that. This is our NPV. So this is the summary. And from this summary, you can tell that the original initial cost was 40,000, and a 5% adverse change increased the cost to, it was 40 million, it has increased the cost to 42 million. The residual value at year 5 in the best case scenario was 2.5. A 5% adverse change reduced it to 2.3, which is very consistent. The selling price was 1.1. A 5% adverse change reduced it to not 1.1. In this case, I mean 11,100. The worst case scenario, it reduced it to 1045. The variable cost was 500. 5% adverse change increased it to 525. The fixed cost was 5 million. 5% adverse change increased it to 5250. The annual sales volume in units was 30,000 units. A 5% adverse change decreased it to 28,500. And the NPV under the base case was 2.3. And a 5%, okay, definitely the general impact now of that adverse change has reduced the NPV to negative 7.9. So this is just a summary of, our data. So the question wants us now to prepare an appropriate chart to indicate the different NPVs for each scenario. So now that we have the NPVs for the best case, and then for the different scenarios, so I can highlight the NPVs together with the headers of my scenario so that it can be able to capture. So let me take these like this, and I go to the data, not data, but under insert. I'll tell Excel to recommend for me a chart, so I'll say recommend chart, and I see which chart best represents this. So the best chart we can have is the column chart. Then I can say okay, and this is my column chart. This is my column chart, and the column chart is showing the NPV, and this is the best case. So let me try to increase the size of this. And let me change this color. If I double click on this, it will only highlight the lower column. So then just I give it a different field. Let me give it a red field so that we show that this is the worst case. Then this one can give it a proper field. Maybe in the best case, we can give it a light blue field. There is no problem. Can make our text bold. Can also increase that. We can also increase so that this will be our chart. Then our chart definitely should have a heading or a title. So let me move it here just beside this. So let me have the chart here. But you don't even have to, it doesn't necessarily have to be beside it. You can just have it below, there is no problem. So that we make it as visible as possible. So these are a column chart. And so we can say that so you can say these are cluster a column chart. Or you can just say these are chart showing NPV of a project under the base, and worst case scenario. You can use Times New Roman and increase or decrease it slightly, then make it bold. So this is our chart. And you can see that the best case scenario, our NPV was 2.3, and that is where we are tending 2.3. And the worst case scenario, it is negative 7.9. That is where it is an inverted chart. And we've said that there is a negative 400 at a 5% adverse change in all the variable causes a negative 440% change in the NPV in the worst case scenario. And you can see that it is actually true. There is almost a 4 times decrease in the NPV under the worst case scenario. So that is it on how we answer this question. You can try out the question and see whether you're able to get the same. In case you have any difficulty, just let me know. I'll take you through, because the question was to prepare an appropriate chart to indicate the different NPVs for each scenarios in B above. I think that is the best we've done. That one is okay. And I'll look for another question so that we go through together, but that's it for today. Try out the question. In case you're having any difficulty, just let me know so that we go through together. So for now, I'll sum another question which is more complex so that